Good morning, everyone, and thank you for joining us for our first China update for the Year of the Dragon on the eve of the Chinese New Year. I'm joined today by Tian Pan, head of our China strategy and product development. As we say goodbye to the Year of the Rabbit, Tian will reflect on the challenges faced by the equity market over the last year and delve into our insights and how we envision the upcoming year unfolding. Tian, before I hand over to you, maybe just explain to us the Chinese Lunar New Year and what it means for you guys. But before you go, just remember, any questions that you guys have, please post it in the Q&A function. Tian, over to you.
Cool, thanks, Darby. Morning, everyone, and thank you for joining us. Today is, like Darby said, officially the last day of the Year of the Rabbit. So the Chinese calendar follows a lunar calendar. So it's obviously many lunar calendars out there, but according to the Chinese lunar calendar, tomorrow starts the Year of the Dragon. It's something that's quite light within the Chinese zodiac. So hopefully we have a positive year, at least for the markets, coming next year or from tomorrow onwards. We have a week off before markets open again, the week of the 19th of February in China. So we will be back in office then. But for today, I'm going to run through what's been happening in China Q4 last year and also some of what's been happening in January. I'm going to start off with some sort of data that we believe has often been misinterpreted by the media. So the title of the slide is the question, do fundamentals still matter? Because it appears that fundamental data coming out of China doesn't or no longer reflects in the listed stock markets anymore. So I want to try and explain that. Obviously, as the title suggests, as quantitative systematic managers, we always believe fundamentals matter in the long term. I'll start with the bad-ish data. So firstly, there's been a lot of talk about deflation. We are not very concerned about persistent deflation, at least not yet. So we've seen inflation, overall CPI numbers hover around zero. We are seeing sort of record real rates in China, which is actually positive for the overall economy. What we are worried about is the potential for persistent deflation. But as I mentioned, we are not seeing that yet. The numbers are hovering very close to zero. We're going to wait for January, February numbers to come out to see how things are. But we do see sort of consumer confidence returning. Another reason why we are quite comfortable currently is that core CPI is remaining consistently above zero. So typically Chinese inflation varies between 1 to 2 percentage points. In the long run, at 0.6, it's still quite far above zero in terms of core inflation. So we're not too worried about inflation at the moment. Relative to the high inflationary environment that most of the world, the US, Europe, and even South Africa has experienced, we believe the current sort of inflation/real rate scenario within China is preferred. Not ideal, but preferred compared to high inflation. If we look at the property sector, it certainly is bad, but we don't believe it's as bad as the media narrative, and I'll show you guys why. So if we look at since the beginning of 2018, which is when the 3 red lines or the debt sort of limitations got imposed on the property developers because they were just growing too quickly and out of control in terms of debt accumulation. That is why they had to issue debt offshore, because nobody would lend them money onshore anymore. So if we look in comparison, the property sector as a whole has significantly underperformed. The entire equity market since 2018, bear in mind the Chinese equity markets have had a terrible 2-year run. It's down about 21% in local currency terms since the beginning of 2018. So over a 5-year period ended December, this is ending January 2023, by the way. But if we look at the property indices, so the various property sector indices within the onshore Chinese equity markets is down between 65 to 77%. So down on average 2/3 compared to 21%. So there's massive underperformance relative to the overall equity market. But why do we say it's not that bad? Because the overall weighting of the property sector was always small in the Chinese listed equity markets. So if we look even at its peak in 2018, it was only around 4%. of the entire equity market. And right now, it makes up less than 1% of the overall listed equity market. So in terms of direct listed equity market impact, it's really very, very small. It's more the indirect impact, the impact on sentiment, the impact in the debt markets, especially the offshore debt markets, where we don't participate in our strategy, that's causing a lot of headaches. But as we previously mentioned, we've actually stayed clear of the Chinese property sector since about 2018. We were probably 3 years too early, but as it stands now, it was the right decision for us to stay out of properties, especially property market debt within our Prescient China balance fund. Moving on to the better data, we are seeing consumer confidence returning. So we use Chinese tourism revenue data here. Why did we choose Chinese tourism revenue? Because it is a data that reflects some type of non-discretionary, non-essential spend, so discretionary spend. So we see numbers in 2019 dropping massively due to COVID. Initial COVID in 2020, 2021 was a slight improvement in China because COVID was largely contained that year. 2022 saw a massive dip again because of the strict lockdowns. China had a delayed lockdown due to its strict measures in the beginning that worked, but then eventually stopped working with Omicron coming through. And 2023, we saw a major recovery last year, where you can see clearly that tourism revenue numbers from both the May Golden Week, so May and October are two of the largest public holiday periods in China, aside from Chinese New Year, which is coming up tomorrow. We are seeing numbers once again surpass pre-COVID 2019 levels. So that gives us a lot of confidence, especially because this is non-essential spend. So we're actually quite looking forward to the release of the Chinese New Year numbers coming through in the next few weeks once we do go through. If we move on to the next slide, PMI. PMI has often been the sort of scapegoat of poor Chinese equity market performance. So often PMIs below 50 have been quoted as being the reason of poor equity market performance. And I want to show you why we don't believe that is the case, because media headlines try and look for a reason every day for daily market movement. And we all know that daily, especially intraday market movement is very, very difficult to attribute to any fundamental factor. Chinese PMI numbers have been sort of hovering around the 50 mark, as you can see in two sets of numbers, relative to its peers, the US, Germany, and Japan. On the manufacturing side, China doing better than all of its peers. On the services side, China also doing comparatively well. If we look at the second set of numbers, the China Caixin numbers, those are the set of numbers that have more weighting towards the private sector, and that's outperforming all its major peers. So relatively on a global basis, Chinese PMI numbers are very solid. So we're quite comfortable with Chinese PMI numbers. We certainly don't believe that it's any reason for concern. So for example, the manufacturing sector is struggling, not because China is struggling. China's manufacturing sector supplies the world. Because the world is in a high inflationary, lower demand environment, people are struggling to pay debt, people are struggling with real incomes globally. Everybody that manufactures in the world will struggle. So if you look at Germany here, manufacturing PMI of 43.3. So it's really showing that it affects everyone, not just China. If we're moving on to the sort of disconnect between, this is a chart we probably showed three quarters ago, early last year as well. We thought we'd update it again this year, is the disconnect between GDP growth and equity market performance. So if you look at India and US, so just to explain quickly, the horizontal axis on this chart is GDP growth up until the end of quarter 3, 2023. The vertical axis, y-axis, is equity market returns also since 2020, but up until the end of 2023, because equity performance data is more readily available. So you can see India and the US, positive GDP growth, theoretically translates into positive earnings growth and translated into positive cumulative equity market performance, 57 and 60%. China, on the other hand, had just as good, if not better, GDP growth. Earnings has been fairly flat in the Chinese equity markets, I'll show on later slides, but the Chinese equity markets onshore down 11% since the beginning of 2020. Offshore, the Hong Kong market down a whopping 40%. So there's a clear disconnect between equity market valuations and economic fundamentals. So we believe over the long term, there must be some sort of mean reversion where valuations will have to catch up to real GDP growth and earnings. So we are well positioned for that in our funds, and I'll explain that when we get to the fund positioning part. So we do believe the sell-off is overstretched in the Chinese equity market. And this slide also shows the valuation side. So you can see valuations as at the end of December, end of January is even lower. We've had a terrible month in January, but on average, the Chinese equity markets are 2/3. So it's priced at around a third of Japan, the S&P 500, and the Indian Nifty 50. So you are buying same earnings for a third of the earnings multiple in China at current valuations. So we believe that is the most attractive in over a decade. It's the most attractive since we launched our fund in 2013. And if we look at earnings, and what I mentioned earlier, cumulative since the beginning of 2022. So the reason we picked 2022 was that's when the hard COVID lockdown came, and that's when earnings was theoretically biggest hit. So if we look at the overall earnings expectations, average earnings expectations have only dropped by just under 2% cumulatively over the past 2 years. But if we look at the equity market index, all of this is in local currency, by the way. Equity markets are down more than 30% on 2% drop in earnings. So again, clear disconnect, and we do believe the mean reversion is only a matter of time. As painful as the market is, it is as painful as it is to bear with the market currently. It is definitely looking very, very attractive. Okay, done with the equity market, done with the economic data, economic and equity market data overall. Just want to move on to the Chinese policy side. So, as the title suggests, there's always a question if China is a friend or the enemy. And as South African investors, I always say to clients that we are in the unique position of not being American. A lot of American investors are actually limited by US policy towards China, of not being able to increase their investments to China, or sometimes having to force to sell their investments into the critical tech sectors in China on national security reasons. As South Africans, we don't have that problem. So we can choose not to invest in China, but we certainly do have the choice to freely invest in China. Moving on to the policy, China-US relations, it continues to be tense. We don't expect any improvements there, at least until a potential Trump presidency comes in again. Funnily enough, the Chinese actually way more prefer Trump to come in rather than Biden. So we'll see what happens at the US elections, but the US continues to limit access to advanced technologies from Chinese companies. The tariff war quietly continues. The US proposed 122.5% duties on tin mill steel from China. There's another proposed 300% anti-subsidies on all Chinese steelmakers. They also proposed tariffs on their allies, but it's like 2%, 5%, and 6% versus the 300% proposed for China. So you can see there's a clear differentiation between China and the rest of the world. China is really getting the harsh side of US policy, and it has to find ways to survive. I'll explain what China is doing, but overall guardrails are in place to prevent the relationship from deteriorating further. So bilateral meetings at a high level of government continuing, military channels are opening up to ensure there's no sort of erroneous military conflict around the South China Sea. So we're quite comfortable with the relationship, although we have no expectations of any immediate improvements. In terms of what China is trying to do to counter that tense US relationship, it's signaled to the rest of the world, especially Europe, which collectively is China's largest trading partner, that is open for business. So unprecedented moves. China granted visa exemptions for a number of European countries in the European Union. So France, Germany, Ireland, Italy, Netherlands, Spain, Switzerland. China never grants, if anyone's traveled to China, you would know that whether you hold a British passport or a US passport or a South African passport, everybody needs to get a visa for China. And that is no longer the case for some of the major economies in Europe. Same with some of the major Southeast Asian economies, Singapore, Malaysia, Thailand. also getting visa waivers from China. And China continues to push for global trade. China is probably the only major economy remaining that continues to push for globalized trade, free trade, because of course it is a beneficiary of it. RCEP, China is a signatory to it, the biggest free trade agreement in the world. China has also applied to another multilateral free trade agreement, CPTPP, and China has agreed to officially upgrade their FTA with Switzerland. They are also pushing for more bilateral FTAs. With Europe, they've committed to a lot more imports from Europe, even with some tensions on the electric vehicle side, which I'll mention a little bit later. So overall, policy-wise, China is definitely trying to engage with all of the world. Also trying to engage with the US, but with the US, it's largely out of China's hands due to all the sort of tech and tariff restrictions there. Moving on to EV, China is now the dominant player in clean energy vehicles. Chinese brands account for half of all electric vehicles sold globally. BYD, many of you will know BYD, it is sort of Warren Buffett's darling. It is the sort of electric vehicle / battery champ within China. It overtook Tesla in Q4 last year to be the biggest EV brand in the world by sales. BYD, by many estimates, is estimated to have a 25% cost advantage over US and European rivals, simply because they own their entire supply chain. I mean, they build the batteries themselves. They don't get it from a supplier. Battery costs in China for EVs on average between 11 to 20% cheaper in China relative to the US and the EU. And China now, including combustion engines, is the largest car exporter in the world. So all of these, it shows this is probably the flagship sector that's developing in China. Other sectors, including solar, other new energy, China's committed to be net zero by 2060. So they're really putting a lot of investments into the sector. So overall, the economy is transitioning from your sort of low value, cheap manufacturing to moving up the value chain. And the EV sector, the solar sectors are prime examples of that. EU, I mentioned earlier, launched an anti-subsidy investigation into Chinese EVs, mainly to protect Europe's existing legacy car manufacturing industry. And we eventually expect some sort of tariff to be put on Chinese EV imports, but we don't expect it to impact overall China-EU trade that much. I think the EU will find the right balance. So as an example, French car makers with not too much exposure in China or not too much sales in China has been pushing hard for higher tariffs, while German automakers and the German government with a lot of sales and a lot of exposure within China pushing for a much more sort of mellow approach to the whole situation. We'll wait to see what the results, but eventually we expect some sort of tariff to be applied. Taiwan is a risk we believe is exaggerated. As we've said in many previous webinars, we do not believe Taiwan is the next Ukraine or will be the next Ukraine. We continue to believe so. Taiwan's elections in January came out with a much more balanced result. The DPP, which is the pro-independence party, lost 17% of their votes since the last election, last presidential election. Their total tally came to 40% from the previous 57. They lost their legislative yuan majority, which is the equivalent of parliament. So we don't expect any risk. The risk of far right-wing independence policies even lower than now. So where the DPP now actually has a parliamentary majority. So risks are actually declining from that front. The current mood is fairly negative for Taiwan, but it's limited to Taiwanese stocks, not really impacting Hong Kong, mainland Chinese stocks within the Greater China region. So we're fairly confident in that. Happy to talk to any questions on the Taiwan issue a little bit later. Yeah, with that, moving on to our position and performance. It's certainly been a very tough period for the Chinese equity markets, and we are doing all we can to minimize the downside. And we have done successfully, especially within our balance fund. Our sentiment model, very, very volatile, currently close to zero. So we are around 65% equity market upside exposure, slightly lower, between 55 and 60% equity market downside exposure. with dynamic asset allocation and derivative protection. Overall, if sentiment turns, we can very, very quickly go up to 90 to 100% equity exposure. That's how the fund is positioned. If we look at performance, we've had some tough years. We've had 3 years of negative performance now. This is because the markets have tumbled so much. Within the balance fund, we've done better than the market, but we right now, as valuations stand, we are positioned as aggressively as we can, because we know if you can see where my cursor is, where the Chinese market rallies, it typically happens very, very quickly. And we want to be ready for when that fast rally happens. So that's the key focus of our fund. So on the downside, it might be slightly higher than historical average of around 60 to 65%, but our aim is to capture the full upside. If we look at shorter term performance, this is to show since 2020, because the market's been really volatile. The gold line on this chart is the Prescient China balance fund versus the Chinese equity market. So you can see it's on the upturns, we pretty much keep up, and on the downs, we are much less volatile on the downturns of the equity markets. You can see from where it's circled on these charts. If we look at since October 2023, so it's October last year, end of October, where the markets struggled, the equity markets struggled. You can see the gold line now, Prescient China balance fund, fairly smooth, still slightly trending downwards, but we managed to protect a lot of the downside. So with these slides, I just want to emphasize that there may be a lot of China negative headlines. There may be a lot of headlines saying the Chinese markets have collapsed, Chinese sector has collapsed, but inside the Prescient China balance fund, you are not getting just the Chinese market. We are doing our daily dynamic asset allocation every day to try and make it as smooth of a ride as it is as possible for our clients. And this data tries to illustrate what we are doing with the fund. And at the same time, while smoothing the downside, we are trying to maximize the upside for when the upside does come through. So again, this is just for the month of January. KWEB, which is the Crane Shares China Tech Sector ETF, probably the most popular China ETF on the US exchanges and globally. For the month of January, it dropped 13.5%, whereas our Prescient China balance fund dropped only 5.5%. So we outperformed that by 8 percentage points over 1 month. So it just gives you an idea of the sort of relative downside protection that we have. The gold line again, our Prescient China balance fund. So investing in our fund is not sort of full exposure to all the risk in China. So yeah, I guess I said that again. This is a long term since our inception. The gold line again, our Prescient China balance fund. This is a comparison to pure equity indices. And what we're trying to illustrate here is that on the up, we are able to keep up with pure equity markets, as in 100% equities, and on the down, on average, we target around 65% of market downside. And over our almost 11 years of history, this chart proves that we've been able to do it, and we'll continue to aim to do that going forward. You can see on the ups, we pretty much keep up with the market. On downs, we drop less than the market. And over an 11-year period, we have significantly outperformed every single pure equity index on China that there is. So we're quite proud of that. It's unfortunate. We're very frustrated of the recent negative absolute performance, but in terms of relative performance, I think we're quite comfortable with our relative performance. Okay, moving on to Morningstar ratings. We continue to be rated 5-star for all long periods, but for 3 years, we've dropped from 5-star to 4-star, largely because within our category, the China multi-asset category globally, we've started to lag behind the fixed income focused funds. So funds with only 20% equity, 10 to 20% equity exposure have started to beat us over a 3-year period. So we slightly dropped, but over the long term, as long as one believes equity markets go up in the long term, I think we are quite comfortable and confident that we will continue to be 5-star rated. And that translates into pretty much top decile or top 10% amongst global peers in the same category. Prescient China equity fund, I'll go through very, very quickly. Not too many clients are invested in that because we only have the US dollar version. We continue to eke out small bits of alpha, which is consistent with our philosophy, is that we don't want to give clients massive alpha the 1 year and massive negative alpha the 1 year. And that puts the risk on the client as to when they come into the fund. And we want clients to experience a consistent alpha profile. And since the inception of our fund, you can see that our alpha profile has consistently grown. So we continue to aim for growing alpha. Overall, we're about 1.5% per annum net of fees ahead of benchmark. Gross of fees are around 2.6% ahead of benchmark. Morningstar rating for our equity fund, because it's a pure equity category, we quite comfortably beat most of our peers. We are rated 5 stars for every single rating category there is. That means we are consistently around or within the top 10% of global peers investing in China equity. Okay, so I guess to summarize for today's webinar, China's economy is getting stronger. The geopolitical landscape remains complex. We don't expect China-US relations to get better. We do expect China to make progress with economic and trade deals with the rest of the world, with emerging markets, and potentially with the European Union. There are a lot of conflicts going around in the world. There's talk of World War III, but we believe China, because they are not directly involved in many of the conflicts, may very well play a mediator role in many of the conflicts. Overall, the Chinese economy and the stock market remain too large to ignore, and we do not believe China as a country, as a market, will end anytime soon. When I say anytime soon, it's maybe in the next 50 to 100 years. I don't know, but it's not going to end in the foreseeable future because media tone typically tends to suggest that in the long bear market, and we totally understand that. The tone is negative, sentiment is negative and weak, but we need to filter through the noise and focus on the real data. And as tough as it is probably the best buying opportunity in China right now in over a decade. So with that, I think I'm going to move on to questions.
Yes, thanks a lot, Tian. There's a number of questions that has come in. The first two is on the property market. Perhaps you can just recap the percentage of the property market to the Chinese GDP. And the question is then, how can China defy gravity if the property sector does not recover?
Yeah. Okay, so I think there's been a lot of misconception about how much the Chinese property sector itself, probably around 4 to 5% of Chinese GDP. The numbers one would have seen in media that's been quoted is around 20 to 25% of GDP. And that's taking into account all the related industries. So if you take into account the steel industry, the concrete industry, the construction industry, etc. But not all of those industries are directly related to residential property. So property, for example, and even within residential property, not all residential property are struggling. So for example, residential property in tier 3, 4 cities, which is your poorer cities in China, have experienced a much smaller drop in price, and they are much smaller in terms of overall size relative to the overall property sector. Whereas properties in tier 1 cities are way more expensive and much more prone to dropping, but they haven't dropped. So there are a lot of complex moving parts within the property sector, but the biggest impact of the property sector, I would say, is indirect impact. So there's not really direct impact on or not anymore, especially now that it's less than 1% of the listed stock market. So we're not too concerned about that. But what it does is, with the drop in properties, as you suggest, or as the question suggests, the gravity part is difficult to ignore because it affects people emotionally. And that's what we've seen. We saw in April last year a massive drop off the cliff in terms of Chinese consumer confidence index. And that's where the wealth effect comes into play. But what I like to mention is that many of the sort of wealth effect issues related to Chinese properties is paper wealth effect. So people are pretty much paying a fixed bond payment. Most bond payments in China are variable rates. Interest rates have actually come down, so monthly bond payments have actually decreased. So the drop in paper wealth is in most cases purely emotional. So that doesn't affect your month-to-month cash flow. And while that will hit people's emotions for 3 months, 6 months, 12 months, maybe 18 months, eventually people will realize money coming into the bank account every month is actually increasing because of the interest rate cuts. So we are not too concerned about that. But yes, for the interim, probably since about second quarter of last year, the property sector has really hit sentiment, consumer confidence and sentiment. And that's probably our biggest concern. Overall, we don't believe the banks balance, top tier banks, their balance sheets are very clear of the bad property debt. A lot of high net worth individuals have suffered losses from investments into products that invested into underlying property debt. But overall, the mix is fairly balanced. And we do believe we're seeing a lot of anti-corruption campaigns coming through to try and recover funds that were embezzled, etc. Overall, the fix is coming through. There will be an annualized impact on GDP going forward, we believe, but it's not something it's not nearly something that's going to end the Chinese stock markets, as many media headlines suggest.
All right, you talked about the wealth effect. So, second property question. How much of the Chinese consumers' wealth is tied up in property? And are you not concerned that the equity market investment locally is being delayed as Chinese investors have to build up savings in more non-risky asset classes?
Yes, so there's certainly a lot of wealth locked up in properties. And that's actually, and with the property market crash, ironically, we believe it's actually a good thing in the long run. So it frees up. So if we look at average Chinese household, if we look at tier 1 city, I'll give an example, Shanghai. One of our local colleagues there, actually, he said him and his wife's parents and his parents, the 6 of them together, spend most of their disposable income every month servicing the bond for their one property. And that's because the property prices are so high. And with the correction in property prices, not so much in tier 1 cities yet, but in tier 2, tier 3, tier 4 cities, there will be a lot more disposable income coming through in the next 5 to 10 years. Obviously, it's not a short-term phenomenon. More disposable income that will come through, more affordable housing, and more potential money that can flow into the stock markets. But in the short term, like you say, the wealth effect is big because on average, around 70% of Chinese family household wealth is tied up in property. But then again, I just want to reiterate the point I mentioned earlier. A lot of this is paper wealth because these properties are not held for investment. They are living in it. They were not going to sell it anyways. So while there might be a 6 to 18 month period of emotional impact, it doesn't impact their cash flow. So hopefully that answers that question.
Yes, thank you. Moving on to the next topic, equity market and rebound. So in your view, what factors could trigger a rebound in the broader equity market, and how significant do you believe the recently announced stimulus will be in influencing a turnaround in global investor sentiment towards China?
So stimulus has been short. There's been a shortcoming in stimulus by many domestic or foreign. Everybody wants more fiscal stimulus coming out of China. Monetary stimulus, we believe, will be limited because there's not too much scope to cut more rates because of the high US interest rates. There's limited scope by global central banks to cut rates. We expect more cuts in reserve ratios, small cuts in interest rates, and potentially we expect more fiscal stimulus to come through after Chinese New Year. So I think that'll slowly, there's been a range of policies, just nothing nuclear, like what the Fed does, hand out $8,000 to everyone, or not the Fed, what the US Treasury did during COVID. There's none of that in China, and China, nobody aside from the US has the luxury of doing that. The US dollar is the reserve currency. They have the ability to print a lot more than every other central bank. So China doesn't have the means to do that. In terms of the factor that will cause the equity market to turn, I wish I knew the answer. So our back testing historically, so we've probably been through 4 major bear markets since we've been in China. Or not since, 3 major bear markets, bear and bull markets. and we've studied 4 major bear and bull markets, and every time it's a random factor that actually triggers that rally. You can never tell it ahead of time. If you back test, you can always try and allocate it to something, but it's almost impossible to forward look. But right now, if we look at the valuations, if we look at the sentiment data, it has pretty much surpassed every single level of previous bear markets, including that of probably on par of the 2007, 2008 levels. So we have surpassed previous bear bottoms, and we can only be closer to that sharp rally that's coming through. I mean, 2 days ago, we saw big caps in China rise 4.5% in one day. We saw small caps rally 8% in one day. This is not single stock. This is index Y level. So, I mean, 2-3 days of these moves, and all of a sudden you're up 15-20%. And this is why I mentioned earlier, we are positioned so that we don't miss those sort of rallies. That's why we adjust every day our dynamic asset allocation. Well, not always every day, but we adjust daily where we necessarily have to. So yeah, unfortunately, I don't have the answer for that market turning factor, but we are as positioned as we can be for that.
Yes, if you had the answer, you would have retired by now. Staying on the stimulus topic, is there perhaps a concern that Chinese consumers might develop a habit of delayed and more selective consumption, relying primarily on the targeted stimuli?
Yes, absolutely. I think Chinese consumers have always been sort of your picky buyers on average relative to your Western consumers. There's always big focus on average. The consumption culture is already like that. With the drop in sentiment, there's certainly been a lot of delayed purchases. But I think again, going back to the point I mentioned, we already saw some of that probably March, April last year. So we are almost coming up to 1 year of that sort of poor sentiment, poor consumption mindset. That's why I showed the tourism revenue numbers. I actually moved up to that slide. So those were very encouraging numbers because tourism spend is not necessity. It's not necessary spend. So when we saw those numbers jump above 2019 levels for the first time last year, we thought, okay, this is the first sign that consumers are coming out of that slump. Because it's not that there's no money to spend; it's just the willingness to spend. So we don't know when it's going to come back, but as long as actual cash flow of Chinese consumers are not affected, it's just a matter of time before they start consuming.
Okay. Then a question I quite like, and I think is you talked about the correlation of the Chinese market to sort of for South Africans compared to the rest of the world. Is China still perceived as an uncorrelated investment opportunity for South African investors, especially considering the increased interconnectedness of South African economic fortunes? And this interconnectedness potentially heightens the risk associated with investing in China compared to other EM and developed markets.
Absolutely. I mean, the interconnectedness seems to be coming a lot from a policy side, not from a practical sort of, earnings side, if I can call it, aside from the Tencent Naspers connection. So if we look at, I think, actually speaking to one of the local fund managers in SA earlier this week, the number that was mentioned that on the JSE top 40 or all share, only around 15% of the companies are your SA Inc. That's when you strip out the banks. So when you invest in the JSE, you're actually getting about 85%, or maybe not 85%, but at least sort of 65 to 70% offshore sort of economic environment business exposure. And to answer that correlation question, China onshore, so not Hong Kong, China onshore, where our funds are focused, has consistently been the best diversifier for all offshore sort of indices globally. So including the S&P 500 and including the the JSE All Share. So just to give an example, our studies have shown that the MSCI Emerging Markets Index has something like an 85% correlation to the JSE All Share. So if you think you're getting a lot of diversification by getting MSCI EM exposure, you're not really getting an 85% correlated exposure to the JSE. If you're investing in Hong Kong, which is like your Hang Seng Index, or MSCI China, which is the China Offshore Index, you're getting something like a 75% correlation to the JSE All Share Index. And that, when I say JSE All Share, that includes the cap SWIX, that includes the cap P. So however all the variations of the JSE indices. But if you invest in the Chinese onshore, you're getting around 40 to 45% correlation. So it's by far the best diversifier. Unfortunately, for the past couple of years, I think in US dollar terms, if we take a 3-year approach, South African equities have been dated, Chinese equities have been dated even further. So I guess on a valuation basis, both SA equities and South African equities in terms of valuation are looking very attractive.
I think we don't get a lot of news flow, or we get a lot of Western news flow, but maybe from your point of view, and since you're situated in China, Shanghai, what's the current state of typical Chinese citizen, and what are their anticipations and primary concerns? Or the second part of the question is then, what is the actual sentiment on the ground amongst Chinese citizens, given the prevailing discourse suggesting political uprising against the establishment?
So the political uprising thing is just it's so far from the reality on the ground. It's really nothing to be worried about. I mean, when I had that slide, Taiwan is not the next Ukraine. I think that probability is like 0.something% if I had to suck a number out for it. The risk of political uprising in China happening is even lower than that probability. Generally, I would say majority of the population very comfortable with the government, very supportive of the government. If we look at all sort of satisfaction indices and surveys, Chinese citizens, even after COVID, are probably some of the most satisfied with the government globally. So largely because in terms of real cash flow and real economic experience, on average, people are still getting wealthier, even with COVID. So when I say that on average, so your tier 3, tier 4 cities, there's still massive, almost 100% support for the government. Everybody, Chinese citizens are quite happy. Tier 2, tier 1 cities, less so, but still massive support for the government. There's not really an issue. Where there is sort of unhappiness with the government is probably the same group of the population as everybody on the call today. So your investors in the stock markets complaining that the government's not doing enough in terms of stimulus, in terms of supporting the equity markets. Obviously, there will be unhappy parts of the population in the property sector, in the construction sector, because they are either getting salary cuts or losing their jobs. But overall, the sort of political environment in China is as stable as it ever was. The stability might have dropped from 98% to 95% throughout the COVID years, but in absolute terms, there's nothing to worry about. I think we probably mentioned it long ago that we believe China is probably one of the most politically stable countries to invest in emerging markets. So we continue to believe so. So yeah, no issues there.
Thank you. On the population, it's gone into negative decline territory. And how does that bode for investors over the medium to long term?
I'm actually not worried at all. I actually think, okay, as long as we don't get continued population decline. So let's remember there was a lockdown. We need to see 2024 numbers. There was a lockdown and after effects of the lockdown for 2022, 2023. Population growth will decline. As long as we don't get into a massive decline annually in terms of population, I think it's actually a good thing because people, the media headlines complain about a decline in population, and that's largely caused by declining birth rates. And then they also complain about high youth unemployment. But if we combine the two, if you look at youth unemployment was something like 21% before they stopped publishing it. Last year, when they published it again, it was 14.9%, if I remember correctly, around 15%. Even at 15%, that's the national average unemployment rate is 5%. So youth unemployment is at least triple overall average unemployment. So a small decline in birth rates actually helps with the youth unemployment in the short term. Obviously, longer term structural changes in the economy are needed. So, but I'm not worried at all about that small one-off decline in the population. And moving forward, we do expect slowdown in Chinese population growth, even if we do return to growth territory. But as long as that decline is stable, it's really not cause for concern for the next 2 decades. If we want to understand what will happen in terms of Chinese, how the population changes to the economy, all we need to do is look at Japan. We can look at Western Europe, we can look at South Korea as examples, because they're about 1 to 2 decades ahead of China in terms of declining birth rate scenarios. So it's really not an issue. I think, again, it seems to a point that the media tries to find a reason for daily market movements, and soon enough they'll run out of reasons, and they try and find every single factor to sort of explain daily market movement. But we all know it's very difficult to move daily market movement, even weekly, monthly market movement. So not too concerned about the population, at least not now. We need to wait for another year or two of population data releases.
Thank you. The last question or two. I think we've just about covered all the questions today. In the current market conditions and asset price dispersions between cash, bonds, property, and equity, what, in your view, would a more balanced approach to China be advisable versus equity alone? So I guess our balance fund versus our equity fund. I think your slide almost summarizes that.
Yeah, I think we've always said, typically, I mean, we've got our 2 flagship funds. And typically our clients in our China equity fund are pure institutional, sort of your pension fund clients that just park the money there, and they are big enough to have their own asset allocation capabilities within China, or at least within emerging markets. So without that, we would always recommend an investment into our Prescient China Balance Fund. So firstly, we have a Rand feeder fund, which makes local investment easier. And secondly, it's sort of all-in-one China product. We manage the asset allocation for you. You don't have to develop that capability yourself. Within a market like China, which is heavily volatile, one really needs a very robust asset allocation process. One really needs a very experienced team managing derivative structures for protection. And that's really been our focus for the past few years. And although absolute returns have been negative, we've generated a lot of alpha on the pure equity market. So certainly right now, I would say equities are, if we just look at pure asset class, Chinese equity is very attractive. Chinese bonds not so attractive because we don't see much more room for rate cutting. Although we don't see rate rises, but I mean, with no rate cuts, you don't get that sort of capital appreciation effect on bonds, and you're getting low rates of around 2%. So that's not very attractive for us. So overall, we are positioned to try and maximize equity market upside within our balance fund.
Thank you. I think our time is about up. Thank you everyone for joining us. As Tian said, as our balance fund, we've got available as a feeder, so you can invest in that in rands, and it's available on almost all the platforms. The equity fund is only available in dollars, but the team is looking to launch a local ETF, so you'll be able to buy that on a BDA account. Tian, I don't know if you want to say anything around the ETF, or how far are you in the process? Otherwise, we can touch on that in the next one.
Yeah, so we are looking to launch it. So our equity fund doesn't have a local feeder version. So our idea is to launch an ETF version of it, and that even allows for intraday trading. So if there is any interest, please chat to us. We are sort of looking at a Q2 potential launch of this year. So that is sort of the timeline that we're looking at. Yeah. And we're looking for partners to launch the product. It would be great if there is interest.
Thank you, and thank you everyone for joining us. Tian, enjoy your Chinese New Year, and we'll speak to you in the next quarter. Have a great day.
Cool. Thank you everyone. Have a good weekend.